Thank you for letting us organizing this session. So I'm Aurélien Portuez. I'm a research professor and founding director of the GW Competition Innovation Lab at the George Washington University in the US. And so the lab organized these sessions, and the lab is just created this year. So it's a very recent university center at George Washington University, and it brings together, from a very interdisciplinary perspectives, lawyers, economists, computer scientists, data scientists, who wants to think and write and engage on thought leadership and academic activities. And so there's two particularities with the lab. First, we are very interdisciplinary and focused on innovation. Like, we take innovation seriously, and we want to think about it and what does it mean. And second aspect is that we are based in DC, but we are really a global center. And we have regional initiatives all over the world. We're starting with local teams in different regions of the world, in Brazil, India, Europe, Australia. So we try to have this comparative and international perspective where what does it mean to do antitrust and thought leadership in different countries so that we can get a comparative analysis. I think that's what we need, and as we discussed all over this festival, we need also to engage not only with developed countries, but also what's going on in developing countries. So that's the mission of the lab, to think of antitrust competition in almost all countries in the world, without just focusing on US and Europe. So this panel is organized by the GW Competition Innovation Lab. I'm thrilled to have like a stellar panel. We're going to have some opening remarks by Alessandra Perazzelli. Alessandra is Deputy Governor of the Bank of Italy. She's a member of the Joint Directorate of the Insurance Supervisory Authority, and also a member of the European Central Bank Single Supervisory Mechanism. Alessandra was very instrumental in setting up the Bank of Italy incubator, the so-called FinTech Milano Hub, which is an innovation center for collaborations in the FinTech industry. My friend, Oscar Borgogno, who works at the Italian Central Bank and also a senior fellow at the GW Competition Innovation Lab, will moderate a discussion between Elizabeth Nobles and Anna Zanacchi. Elizabeth is a senior policy advisor. She's going to join us online. And she's the principal advisor on innovation at the European Banking Authority. She's also a visiting professor at the London School of Economics and the European University Institute. Anna is lecturer in law at the University of Leeds. She's an affiliate fellow at the Stingler Center at the Chicago Booth Business School and the senior research fellow at the UCL Center on Law, Economics, and Society. She's an associate editor of the Journal of Competition Law and Economics and of Competition Policy International. So it's a privilege to start up this panel focused on intersection of merger control in the context of AI and FinTech. So AI and FinTech have emerged as a pivotal forces, fundamentally altering the landscape of financial markets and services. Just for example, over the last 5 years, the global AI in FinTech market has exhibited a remarkable growth, with projection estimating its value to exceed $41 billion by 2030, driven by a compound annual growth of estimated to be 23%. So it's a really dynamic sector with rapid pace, and that leads to very unique complexities when it comes to antitrust regulations, and particularly in the context of merger controls. A key issue in the FinTech is the growing prevalence of common ownership, which increasingly raises concerns in terms of competition. Recent analysts indicate that up to 80% of venture capital investments in FinTech startups involve some degree of overlapping ownership. While common ownership is frequently championed as a means to stimulate innovation, it has also a potential to stifle innovation by fostering tacit collusion and diminish the competitive incentives. So empirical research supports the notion that common ownership by institutional investors in financial markets is associated with higher price and weakened innovation incentive. As a result, policymakers must exercise heightened scrutiny when evaluating the competitive dynamics of mergers in fintech. The ownership structure inherent to these markets can obscure the true nature of the competitive pressure, complicating the tasks of accurately assessing the anti-competitive effect, potentially, of some mergers. So I look forward to listening to more on those topics and this different from Alessandra's remarks, and then we're going to have a little panel discussions and conversations moderated by Oscar. So Alessandra, the floor is yours.
Thank you so much, Aurélien, and thank you for having me here. I actually love this place, and it's fantastic to be able to have this beginning of the last day of your conference here. First of all, I just wanted to say that as a deputy governor in a central bank, and I'm the member of the board that actually works on supervision of banks and other financial institutions, I just wanted to say that the title of this conference and the issues that are raised here, they're extremely important. Important because what we are seeing right now in the market is really like the entry of technology within the business plans and the business and the operational plans of banks and other financial institutions. So technology is becoming really one of the most important issue that is going to bring to really what I define, and not only myself, but also other, a revolution in the way in which services are going to be provided and companies are going to be run, and also consumers are going to have access to a number of financial services. And I believe that once we are now trying to organize the entry into the market of these new operators, and I can tell you that between the last 4 or 5 years, if we look at the number of licenses that we are being granted, say nearly 87, in this span of time, only 2 licenses were granted to banks. So 85 were granted to non-banking institutions. And all of this present themselves to us with business plans that are based basically on platforms, all right? So the issue of interconnection of the financial systems is becoming very important, and how do we measure risks is going to become extremely important for us, especially as we work in the as supervisors at European Eurosystem level. What we're seeing now is one of the main issues is how do we measure these risks that are associated with platformization, as we call it, and interconnections among the different platforms. So it's very good. I think that we look ahead and we also check, what competition, what's the role of competition law is going to be into this. Because one of the other very important trends that we're seeing is concentration in the market, particularly when it comes to some providers of technology and other services that right now are lightly regulated and they do not fall within the prudential supervision as we know it, okay? So there is a huge, I think, territoire for competition law to come into place. And this is very important that competition lawyers and professors have they really sort of like have a good encounter with technology, that they understand technology, because technology is going to be pretty much at the core of the businesses that we're going to see becoming more and more important in the marketplace. So today, the panel that we're having here is perfect. Aurélien, you're going to be chairing it, and then we have Anna Tsanaki from Leeds University, Elizabeth Noble online, and and I really look forward to your insights on Anna on minority investments and everything, which is the evolving definition of control, which is extremely important because, it goes together with the work you've done on common ownership, and this is something, quite important. And I think that this is going to be a type of research that's going to have a strong impact on understanding how market concentration dynamics and how the market power works when, and it evolves into abuses of dominance and structural inefficiency that is, affecting then the AI innovation in finance. Also, we're going to be hearing from Elizabeth, the analysis on the impact of consumer financial data in the context of non-horizontal mergers, and I think as the financial sector faces this digital transformation, driven by open banking policies and advancements in data storage in AI, the role of data in merger assessments is fundamental, becoming more and more relevant, and we need to keep an eye on this. So, I think that all of this, of course, has a lot of sense and has to be put into the context of the, drawing some parallels with big tech mergers. I think these issues of database theories of harm are extremely important, and we need to look into this with new eyes. And then, of course, I like to see here my colleague and good friend, Oscar. I think he will guide the discussions on all these issues. Oscar and I have been working together particularly on regulation of AI. He's one of the few lawyers within a world of economists, and it's good that we have Oscar and the Oscar what likes in a central bank. I'm a big fan of that. Okay, so I stop here. I will join the panel, and and I'm sure you're going to enjoy the conversation. Thank you so much.
Okay, what a wonderful time to talk about minority shareholdings in fintech and artificial intelligence merger control. So, Hannah, we are very, very much looking forward to hearing about your views on how competitive dynamics are changing the way merger assessments should be carried out when it comes to artificial intelligence and financial technology, of course. Again, thank you for being here, and the floor is yours.
Thank you for inviting me, both the GW Competition Innovation Center and the terrific team of Lear for the excellent organization. And I have to say I really appreciate the fact that I'm in a panel with 3 women, so we're outnumbering for once, even if one is virtual. So thank you very much. I don't have slides, so I will keep it a little bit more dynamic, and then we'll have time for discussion as well. So we see a lot of things happening in the AI innovation space. We see a lot of partnerships forming, and we see a lot of activity, interest from regulators that want to catch those deals and review them in the first place under merger control rules. So maybe regulators are a bit afraid from lessons from the past with regard to digital platforms, so now they try to be more proactive with regards to these deals. So I think I'll focus my presentation, so to say, in a few topics. So first, are these investments that we see mergers? Are they quasi-mergers, as some people call them? Then the discussion with minority shareholders, are they partial mergers? How should we view them? How we should analyze them? What factors should we take into account? Is there a change of control, and so on? And then I want to discuss some more legal questions. For example, should we review them under regular merger control, ex ante, based on what thresholds? In the EU now we have a very big discussion about those thresholds, and we had the recent judgment from the European Court of Justice in the Illuminal Grail case, where the Commission tried to bypass those thresholds. So a lot of things are happening. And it's interesting to see how much law can catch up with the reality that we're experiencing right now. So I have a list here of tech acquisitions in AI startups. I will drop some names. For example, we have NVIDIA, who is a very big player. Let me not say dominant, because that's a sensitive word, in the specialized chips that are needed in this AI ecosystem. So NVIDIA recently acquired or tried to acquire an Israeli startup called RAN. Then we have the other more traditional big tech players. We have Microsoft that has investments, as we know, in OpenAI, and we had some drama there with their governance structure as well. I'll talk a little bit about that. Then we have Microsoft trying to acquire Mistral, which is, interestingly, a European AI startup. Then we have Microsoft again with Infection AI that tried to acquire, as we say, to acquire some talent, the owners basically, and a very big part of the team of Infection AI. And that has also caused a lot of investigations in the US, EU, and the UK. Then we have Anthropic, and both Amazon and Google have invested heavily in Anthropic. We have Google and Character AI. We have Amazon and Adept, also another acquihire, which is very interesting, and some other deals. I will not bother you with this list, but I take this as a starting point to think, what are these things that we're talking about? So some people call them partnerships, some people call them investments, some people call them mergers. What they are, I think they're a mix of things. It's interesting to see that we don't have a traditional merger where you acquire 100%, of course, of the other company, or even you have a majority stake acquired. Mostly what these deals are about is to acquire talent, I think. So it is what we call acquihires. And then they structure other things around that to make it more tight, so to say. For example, we have licensing of IP that goes together with these AI foundation models. And we also have some non-compete agreements and things like that. So it's interesting to think why these people tried to pursue these deals instead of an outright merger. Maybe they don't want the scrutiny. That's a little bit evil way of looking at it. And they also want, this is a very fast-moving market. So once you have the right people, you almost have most of the things you need. The big players like Microsoft, Google, and AI, they have a lot of other resources that can leverage to make that talent work in an optimal way. And we can see actually that many of the people, for example, some of the talent that was acquired was first working for the big tech, then they dropped Google's DeepMind, and then they jumped and they just started their own thing, their own startup, and now they want to go back, from a very different place and expand. So it is a very dynamic market. The other interesting thing I think that we see is one note here. So what are these acquihires and what is acquisition of control? In the EU, in order to have a merger, you need to have acquisition of decisive influence, okay? In other jurisdictions, for example, the UK, either there are lower thresholds of influence, for example, material influence in Germany, competitive significant influence, but basically you don't need to have 50% of the company in order to launch a merger inquiry, let's say. But decisive control could also be interpreted as de facto control. So even in the case of Microsoft with OpenAI, that they have a 49% stake, in theory, we could capture those transactions under the merger rules. Now, OpenAI is a very special case because Microsoft has 49% in terms of ownership in the downstream subsidiary, which is a profit organization, so a normal company. However, that subsidiary is owned by a mother company that is a non-profit and that has its own board, and actually Microsoft does not have any voting rights, so how we establish control in that situation. Until recently they had a board seat at OpenAI. Google also had one, so after this merger inquiry interest from regulators, they dropped that. So it's very hard to show control, and I mean, Microsoft is an extreme case that they have 49%. In most of the other cases, the minority shareholdings are pretty tiny. So they're very small, and they're more interested in, investing with capital and then having licensing agreements, as I said, as a substitute. So establishing corporate control, I think, in my view, it could be very hard in this situation. We saw something interesting in the case of Microsoft and Infection AI. So the EU, because of its turnover thresholds, could not look at that deal. But we have a referral mechanism in the EU, which is a bit legalistic and complicated, how it works. And the Commission thought it's good to expand that mechanism, so even member states that could not review a member could refer a case to the Commission to look at it. So some member states tried to do that with regards to Microsoft Infection AI. In the meantime, we had the judgment from the Court of Justice, as I said. Unfortunately, the Commission's expansive view of this Article 22 referral mechanism did not pass. So that was cancelled, all these referrals were withdrawn. But interestingly, so the Commission said we don't need to do nothing, we don't comment, but they kind of shot the gun because they said, oh, but we think that this was an acquisition of control, and even if it was an acqui-hire, they saw it as an acquisition of assets, as they said. So it was not corporate control, but it was acquisition of all the assets of the company, and since the company, after they were acquired, after the founders basically of Infection AI were acquired by Microsoft, they decided also to shift their business to another segment of the market. And the Commission thought, oh, there was a structural change in the market, so we think there is an acquisition of control. So they tried to put it as a placeholder here, I think, and that, okay, it's an active phase and we're watching you. Now, let me go back and talk a little bit about most of these investments when we see a lot minority investments and cross and common ownership, and I think that's another very interesting aspect. We don't know so much about it. I think also it's very dynamic. I mean, we see a lot of these VC people, they seem to know each other and then invest in different ventures and people that they know that are the founders of these AI startups. So we see two things. We see a lot of common ownership from a VC, and then we see a lot of these VC people are also on the boards of these AI. So we see interlocking directorates. We see if we don't have interlocking directors, we can have observers, as I said. And that raises also the question, okay, there are two questions, if we have control and if there is a flow of information.
Collusion.
Yeah. And then I think it's interesting to see how we should analyze those deals. I have also some work on killer acquisitions where I'm trying to explain how we should approach this issue from a legal point of view, given the institutional structure of the EU. But the interesting thing, I think, for this discussion is that, I forgot what I want to say. Okay. What I was saying before. Okay, let's move to the next one. Okay, so.
But I mean, I might just jump in to ask you a question, a very brief one, so that we'll have time at the end of our session to engage with the audience and with the rest of the panel. You really did a great job in summing up all the aspects involving minority shareholdings in artificial intelligence. I'm just wondering if you're considering as well the cross-border impacts, because we're really talking about global markets, right? Mm-hmm. And in this case, if, let's say, the EU Commission assess a quasi-merger in a certain way, and the DOJ and the FTC in the US, they just take another approach, this will just give rise to huge, really huge inefficiencies, huge transaction costs. And
that is what that paper was about. So it was about killer acquisitions, but what was it really about? So we have mergers that we don't know to begin with when we look at it from an ex-ante perspective if they're a killer acquisition or not. There is no killing yet, and according to some people, you don't need the killing to have a killer merger. It could be a softer killer, as Pierre Gibault calls it in his framework. So it's very hard from an ex-ante point of view when you have complementary assets to see to assess, because you will have efficiencies and maybe you will have some anti-competitive effects to assess that. The other aspect is, the interaction of different agencies with more or less claim, geographic claim over those mergers. So in that paper, I say two things. First, in the EU, I explained why they tried to use this referral mechanism to catch those deals when the target will have essentially no turnover. And since the EU will have only turnover thresholds, that was the only way to capture them under the European merger regulation. So I'm saying that this system was very certain, it was very clear-cut, but it had two problems. It created a deterrence problem and an externalities problem. And the new solution does not solve these problems, precisely for the reason that you're saying, because, for a deal that has no nexus to the EU or any member state, now jurisdiction can be claimed. And there are certain rules, in international law and so on, of how this should be done. You should have at least some minimum, and especially when they involve also foreign companies. So they would be also kind of a diplomatic issue, I think. Since, a lot of these firms are US-based firms, and we can see, let's say, if Trump gets elected, what kind of rhetoric we will have. Oh, the EU wants to regulate our firms. There could be a lot of interesting things happening, I think. Yeah.
Thank you. Thank you so much, Anna, for your presentation and for your brief answer. And now I'm giving the floor to Elizabeth. She's going to talk us about consumer financial data in non-horizontal mergers. So we're slowly moving towards the financial sector. Elizabeth, thank you again for being with us, even if not in person, unfortunately. But again, the floor is yours.
Thank you very much indeed, and my apologies for not being able to be there in person. I very much intended to be, but unfortunately flight problems this morning stood in my way. So for this discussion, I will approach the issue of mergers and competitive impacts through the technology lens in a slightly different way. So not through the prism of shareholdings, but through the prism of data access. And this can be contextualized by reference to a paper that we are hoping to publish shortly, which is a BIS, so Bank for International Settlements, working paper relating to consumer financial data and non-horizontal mergers. Now on the slide you'll see I've square bracketed financial, because I think our findings are as relevant to the assessment of all types of data rather than specifically financial data. But because John Frost and we come from a financial and economic background, and our colleagues Chris Brimmer and Linda come from a legal background, but particularly focusing on financial regulation, our paper is supported by evidence and data from the financial sector, and particularly the payment sector. So jumping into the specifics, we know that data is proliferating. We generate data in pretty much all of our digital activities, and of course we actively input data when we're using products or services online. That can be anything from Google search when we're entering our search terms to, of course, filing applications for credit products or searching for investment products online using, for instance, comparison websites or other digital platforms that are becoming more relevant as a way of accessing financial products and services. But beyond that, it's not just the proliferation of data in terms of pools. We can see there is an increasing technological capability to utilize data for economic advantage. From a regulatory standpoint, we often historically have discussed the value of acquiring more data, because if we haven't had capabilities to use it, it's almost pointless. You can increase your volumes, but you're not increasing the value of it from either a supervisory or industry perspective if you don't have that ability to leverage the data for your own purposes. But the world is changing, and we are seeing technologies become increasingly available, sophisticated, and increasingly cheap in order to pool together data sets and to really manipulate and utilize those data sets for an economic advantage. So these two factors together mean that, of course, data assessment in the context of mergers can become more and more relevant. And I say more relevant precisely because we can see the growing economic value of data within existing business lines, but also beyond existing business lines. And again, to use the platformization example, if we think about Google, Amazon, and many other big techs and key industrial participants, we can see how data may be gained from one business activity, but combined with data from another business activity, and potentially together, those two combined data sets may be more valuable than those two data sets individually. So in the paper, we note the fact that, of course, data assessment in the context of mergers isn't actually new. We've seen many competition authorities scrutinize data historically. In the EU context, there are several particularly notable cases, including Microsoft LinkedIn, Google Fitbit, and Meta customer merger decisions. But what we tend to see globally is that often competition authorities do not necessarily adopt a clear ex-ante position on how they will measure the impact of data from the competition when assessing merger cases. Now, the impact can be multifaceted, and it can be both positive or negative from the perspective of competition. On the positive side, we know data access can sometimes support competition. And indeed, that theory is something that underpins European regulatory measures such as the Second Payment Services Directive, which of course facilitated the sharing of payment accounts data. And of course, it's also rationale behind the new FIDA, so Financial Information Data Access Directive, which is currently under discussion. But the negative consequences can be severe, and they can include impacts around foreclosure, because that data may not be made available to rivals in the market post-merger. And secondly, and importantly, pooled data that exists through a merger may actually have a negative impact on innovative potential within relevant sectors. And this was a point that was observed in one of the merger cases to which I referred earlier, including the Google Fitbit case, where we saw very clearly there that the Commission took the position that access to healthcare data could, if restricted and not provided to third parties, may negatively impact competition and innovation potential within the market for healthcare devices and healthcare applications in the digital sector. And as a result of that merger assessment, of course, commitments were made to ensure the continuous access of that data to third parties. But I think it's a very interesting case because it shows how actually mergers, when combining two large data pools, can have a negative impact on innovation, and that in turn can have a negative impact from a competition perspective. But as I say, globally we tend to see that many competition authorities do not have an ex ante position on how they will take into account data in merger assessments. Particularly, we see that often when assessing data, competition authorities may lack the tools to consider how that data may be merged and how that combined data set may have a distortive impact on competition. So in our paper, we outline on a very provisional basis certain aspects that could be taken into account in assessing the value of data, and particularly thinking around the complementarity of data sets. So again, when combined, to what extent may they be more powerful as a single data pool compared to the data being held by two separate commercial entities. And for this purpose, we look at some personal data attributes. So for instance, to what extent are the individuals within that data set similar or different, representing different age groups, different geographic areas, different strata in terms of economic position, and so on. I have to say we fully accept this is very provisional, and to those of you who are researchers, we would say this is an area ripe for further research and assessment as we continue to evolve our positions as regulators and public authorities when assessing more and more sophisticated data pools in the context of merger decisions. I would conclude just with a couple of remarks from a European perspective. I think as Mario Draghi put it in his recent report on the future of European competitiveness, we don't see necessarily a need for any legislative changes. So we don't see a need to revise the treaties. We don't necessarily need to revise any of the merger regulations. But perhaps what we do need is that operating practices by competition authorities and guidelines towards industry should be revised to account better for data and innovation to really support that multifaceted approach to assessing competitiveness and innovative aspects when looking at data in merger decisions. So with that, of course, I'll conclude, and of course, very happy to respond to any questions. And just to note that this paper, we think, will be published imminently, and by that I mean at least by the end of this year. But of course, we welcome any feedback on the paper once published, because, as I say, this is probably an area for continuous discussion and certainly further research. So with that, I conclude, and back to you, Oscar. Thank you.
Thank you so much, Elizabeth, and I really can say to all of you that the paper is tremendous. I had the privilege to read it in advance, thanks to John Frost, your co-author. You really managed to bring new light on the topic of non-horizontal mergers. And I do have a follow-up question for you. Basically, you mentioned the Google Fitbit merger, and there was a lot of complaint, especially from academia, and I remember a letter sent by many economists complaining about the approach taken by the European Commission in clearing such merger. And among the main risks that were basically raised by such economists that apparently was not considered enough by the European Commission was the fact that Google, by acquiring Fitbit, So basically, a company that is gathering health data about plenty of people around the European market will have a competitive hedge if eventually it decides to enter in the insurance market for health products. And therefore, we really see the relationship between competition dynamics and financial regulation, because this might be a matter for insurance and financial supervisors that might be interested in understanding how the market might change in the following, let's say, 5 years. So do you see any room for further cooperation between competition authorities and financial regulators in this?
In a word, yes. I think interdisciplinary cooperation and coordination is absolutely essential. And if I may answer your question wearing a slightly different hat, and that's my hat as an advisor at the European Banking Authority, at the moment we're working with our colleagues at EIOPA and ESMA, so the European Supervisory Authorities, to enhance our monitoring of the role of big tech's relevance to the EU financial sector. And we're looking at that through two lenses: the direct role that big techs may have through their subsidiary operations as licensed financial entities to provide financial services, including payments, credit, and other services in the European market, but also their indirect role as technology and also data analytics providers to the financial sector. And this discussion so far shows absolutely the point around the need for coordination, cooperation to think about the dynamics of the business behaviours, even outside a merger setting, and not only within our own sectoral relevance, but also coordinating very closely with the European Commission, particularly in their role relating to the Digital Markets Act, so thinking of the big techs in their role as major platform providers, and beyond that, also with competition authorities in the extent we see the big techs seeking to acquire additional companies in the financial sector. Because going back to the case you cited, I think we need to be very mindful ex ante of the potential for competitive distortions to arise from big techs continuing to acquire small companies, small businesses, whether it's in the tech sector or in the financial sector, and potentially closing out other entities from being able to then access or penetrate similar markets. So yes, we need to be very, very cognizant of the need for continued interdisciplinary coordination in this area.
Thank you so much, Elizabeth, for your presentation again. I'd like now to open the floor to the audience and to the rest of the panel if there are questions for our speakers today. Otherwise, I would just go on. Aureliana, Alessandra, you want to jump in, or just raise your hands and someone will help us to gather all the questions, so we might just very briefly answer all of them, let's say in the rest 5-10 minutes. In the meanwhile, okay. Just raise your hands, and in the meanwhile, I will just ask a short question to... here we go. We do have a question. Just wait a bit. The mic is coming.
Hi, thank you. So I'm a competition lawyer, but I also specialize in sort of AI ethics. And I wondered whether you could offer some comments on regulatory sandboxes in the EU, because I think that's where we see a lot of sort of interactions with FinTech and AI, and I think they have their own problems. But I wonder, I know this is focused more on merger, to the extent to which you think they're still useful for regulators and for FinTech companies themselves to know, you know, for example, the value of data that they're collecting, how regulators might approach it. Yeah, just some comments on that.
Do we have other questions? So we will gather all of them. Otherwise, we will just go straight to the answer. Are you addressing some... okay, we have Paolo here. You have a question?
You mentioned vertical consolidation as a potential reason for concern in some markets, because they're combining data that can be used to exclude rivals. But I personally think also that sometimes vertical competition may be very harmful or can be harmful. And we are doing a work on online payments, and we see that sometimes, there are players that are trying to add layer in the payment system in order to get a larger share of the rent that is created, and somehow this ends up on the price that consumers pay. So can we have, a negative effect due to this kind of competition, that it's different from, the competition that takes place horizontally across firms that try to sell the same product? It's a different way of competing, and I'm wondering whether this is something we should be also concerned about.
Thank you. Thank you again. We do have another question from Gabriele Rovigatti. He's a research officer at the Bank of Italy. As I know him, I just presented him to all of you.
Thank you all for very interesting presentations. Really a quick question, because Elizabeth mentioned the Draghi report, and I mean, we are very interested in this kind of, in the report in general, but in particular in the elements, Draghi suggested across the board, but then also in particular markets, to ease the regulation. And we see, what the report says is that Europe is lagging behind in competitiveness, but also in the innovation, because both regulation and the approach that the Commission is taking, or the antitrust is taking. And I wanted, I'll ask Elizabeth, but I'll ask you all, whether you see that Europe is actually losing, lagging behind, let's say, because of regulations, both from the data point of view and from the merger, let's say the competition policy. If you think that Europe should change in one of the, Elizabeth partially already answered this question, but just how do you see the future of European competition policy?
Thank you so much. So far we have collected 3 questions: sandboxes, vertical integration, and approach to EU competition policy. So I think we will not cover all of them in 5 minutes, but I think to the vertical integration one, Hannah will be in the best spot to answer it, very briefly.
Thank you. That's an interesting question. Okay. You're right. If you look at the horizontal level, the different layers, as you see, you'll see many players. So the market seems pretty dynamic from that point of view. As I said, there are at least 3 big tech competing between themselves for acquiring the startups, and there are many startups.
You mean for Gen AI?
Yeah. Sorry, I should mention that, for example. But it is an open question how we assess that integration of complementary assets, as we said. So probably they could also lead to foreclosure effects if there is more concentration of market power at one level, but we don't know yet. So we don't also know where the technology will go, I think. So we don't know how that market could look like. And I think that is, the problem is not to capture these deals. As I said, the legal questions, we can find a way around that. But ahead of time, we cannot forecast the future. And I think that is a challenge. The regulators are eager to know more. So in the FTC, we had an order of investigation of the whole sector. Maybe we could see something similar in the EU. I think, especially now that, as I said, this referral mechanism idea didn't fly. Maybe they will try, I don't know. One possibility could be that they could think of extending the DMA to capture AI, so it's a more vigilant approach, again, to that. So they could manage those dynamics better before the market consolidates, and we don't know when, if, and how that will happen. So I don't have a clear answer, but just a way of thinking about it. Thank you.
Okay, thank you so much, Hannah. And Elizabeth, I think that the question on the Draghi report and a better approach to EU competition policy might actually touch very well on your research on how to assess consumer financial data in mergers. I mean, do you see any potential from your research in order not to worry that much about the role of data in competition policy? I mean, also as a way to better assess the potential dynamics and, you know, the efficiencies that using data across the industry may actually bring about, apart from antitrust concerns?
Yeah, I mean, it's a very good question that I think touches on a number of structural elements around what are the pillars necessary to enhance the competitiveness of the EU. Part of that is, of course, a competition spree, but part of that is around what do we do from a strategic autonomy lens to create local domestic champions. Some of that may come from our ability to facilitate investments, and of course there's a strong link there to the Capital Markets Union and what we can do to strengthen that. But of course there are also other elements around the possibility for firms to merge, to combine data, and to leverage that to scale their businesses. And scaling is not by itself a problem, but of course one always has to carry out that very sensitive assessment as to whether that scaling ultimately is a good thing or a bad thing, taking into account our societal values. And I think with data specifically, we need to also keep in mind the fact that in the European Union we have an incredibly robust framework that protects data, because that is one of our societal values, and it's a value enshrined in the treaties. And of course, we see that evidenced in GDPR, we see that evidence in the data governance and other data protection acts. So I think we have many different elements to consider when we look to the future of European competitiveness. And part of that will be around thinking of the role of competition policy. Part of it will be around seeing what regulatory tools we can put in place to further facilitate flows of data. And again, I think FEDA is a nice example of that. It's of course still under political discussion, but it's a nice example to see how regulatory interventions may be useful to facilitate data sharing to support competition. But we mustn't forget some of those very important societal values that we also hold close, particularly around fundamental rights and data protection. So I think we will have many years of discussion on this subject about what we can do to really support competitiveness, but I'm sure that will not be at the price of our fundamental values.
Great, thank you. Thank you so much, Elizabeth. And I will just take a few final minutes of our panel today just to give the floor to Alessandra, because I think that as Deputy Governor of the Bank of Italy, she's the best place in this panel to answer the question on the role of sandboxes in addressing competitive concerns in AI and FinTech.
Well, the whole idea of trying to understand better what kind of regulation the market needs at this point of time. It's true that, we're working now on AI. In Europe we have the AI Act. It needs to be implemented and, very much looked into from different kind of industries also point of view. So it doesn't only touches, the financial world, but we've been working on DLT. We've been working on everything that is, concerns payment systems and, how do you regulate markets that are very often not covered by the existing regulation. So the role of these sandboxes or, innovation hubs and this kind of places where you actually invite, both the newcomers, the FinTech of the world, but you also work with bigger institutions that are, moving into the digital world. I mean, let's not forget what it takes, for like a big bank or a financial institutions that has an IT legacy to move into this digitalized world. So those places are very helpful. You know, they're helpful because, well, first of all, because they are a way to promote growth in terms of like promoting new companies, promoting new solutions. But from a central bank point of view, they're also great places where you can observe and look at what kind of, you know, how do we move in the regulatory space? What is that we exactly need in order to authorize and to license, you know, new companies? It's very much, you know, you know, with Oscar, I often make reference to what we've seen in the world of telecommunications, like a while ago, when we had a set of rules that were, you know, covering the analogic type of communications. At that time, you know, we didn't have sandboxes or regulatory places. It was a harder kind of way to come to understanding of what journey, you know, we had to make as regulators. So what we're doing in Banca d'Italia right now, we have a set of facilitators of innovation. You know, there is a very simple channel. You know, people can just send questions, and, you know, whether they have a business model in mind, whether they are wondering whether it's covered or not covered by specific rules, administrative rules that will help them then make, you know, a request for a license. Then we have the sandbox that we are acting in together with the Treasury Ministry, with the Consob and IVAS, which are the regulators of both markets on one side and insurance companies on the other side. And then we have done, you know, like Aurelien was just telling us before, and we started this innovation hub in Milano, and it works on cohorts. It works on call for proposals. Basically, we launch a proposal in, you know, to the market, and then we you know, we take back, we harvest the kind of answers, you know, that they're coming to us, and they're being quite. We just launched third call on instant payments, and that's also going to be very interesting, you know, what you were making reference to, in order to understand what are the technologies, you know, available right now, and whether, you know, there is an industrial interest in the sector. It was very interesting because we received some 26, you know, responses, and also very interesting the kind of segmentation that we had within the industry, you know, smaller, bigger companies and research centers in, you know, universities. So yes, it works, you know, but I do not believe though in those, you know, it has to have something behind that really can work on rules, okay? So it cannot just be like a nice to have. It has to be sort of connected, you know, with a system that is actually interested in moving and changing. And of course, you know, everything which is investment is also extremely important. In Italy right now, we're working on the change of those rules, you know, the testo unico bancario for the Italians. You know, it's the body of laws that regulates also non-banking institutions. There is a big push right now into making private equity and venture capital more available in this country. And so that's going to be very interesting, the combination of an open regulator that pushes for innovation and you know, a better set of rules that actually gives a possibility for investors, private investors, to be active in the market. We'll see.
Just a very one quick word on sandboxes. I'll just second what Alessandro just said. I think the sandbox, for short answer, is the right way to go. I mean, if we've learned something from the Draghi report, is that a lot of regulations that we've passed were precautionary. He used that term. I mean, I wrote extensively on saying that these regulations are precautionary, and we know that there's many unintended consequences of regulations generally when they come into law. And so sandboxes precisely minimize those unintended consequences of getting some feedback loops and getting some involvement. We always talk about regulatory dialogue, but the regulatory dialogue doesn't have to take place when the laws are in place, because you have those kind of non-compliance decisions of the DMA where the regulatory dialogue is already broken, and you cannot engage in regulatory dialogue when you sue the person. It's just like see you in court. So you need to avoid this kind of tensions, and sandboxes is precisely bringing the regulatory dialogue seriously. We've seen that in open banking. We've seen that as well on privacy. I think there was some sandboxing about Google Chrome when they were trying to create this and some feedbacks on these issues. But definitely sandboxing is a way to maximize investments, minimize unintended consequences while taking the regulatory dialogue seriously. So I think we should do more in other sectors and especially in fintech. And especially also, one last one, sandboxing, because you need interoperability most of the time. And what does it mean, interoperability, when it comes to integrity concerns or national security concerns, like data violations or malware? So you need sandboxing, not just to protect the actors, but also to protect from potential malware, protect potential consumers. So you need to know where are the pitfalls. What does it mean, interoperability in practice? What we don't know unless you've tried it. So there's this learning process that is essential to sandboxing.
Wow, so many topics we covered today that we may actually start a new conference straight away. Again, I'd like really to thank all of the panelists that joined us today, to thank the host of this session, George Washington University, and of course, Lear and Paolo for making this possible. Thank you again for being here.